Investing in the stock market can seem overwhelming. Should you trust experts and go with mutual funds, or take control and dive into direct stock investments yourself? In this video, we're going to break down the pros, cons, and surprising facts about both. And here's the twist. By the end, you'll know exactly which one is right for you. But I'm not going to reveal it just yet. So stay till the end because we'll uncover some insights most people never talk about. Plus, I'll share a financial strategy used by one of India's biggest billionaires that you don't want to miss. Imagine you had a $10,000 to invest today. You're standing at a crossroads. One path leads to mutual funds, where expert fund managers make the decisions for you. The other path is direct stock investment, where you handpick your own shares. But which road leads to wealth, and which could lead to unexpected risks? Most people jump to conclusions without understanding the full picture. The answer is not as straightforward as you think, and in the next few minutes, we're going to explore why. Let's start with mutual funds. Picture this. Mutual funds are like a buffet. Instead of choosing one dish, you get a bit of everything. A professional chef, or in this case, a fund manager, decides what goes on your plate. Mutual funds pool money from thousands of investors to invest in a diversified basket of stocks, bonds, or other securities. The goal? To reduce risk by spreading it across various assets. Interesting fact, did you know that the first ever mutual fund was created in the Netherlands in 1774? That's over 250 years of history. The reason they've lasted this long is simple: convenience and risk management. But here's the catch. You're paying for that convenience. Fund managers take a cut known as the expense ratio, and that can eat into your returns. Now, does that sound like the smartest option for building wealth over time? Stick around and I'll tell you the real story about those fees later on. Quick question for you. Have you ever invested in a mutual fund before? If yes, type mutual funds in the comments. If not, type direct stocks. Let's see which investment is more popular. Now, let's switch gears to direct stock investment. This is the a la carte option. Instead of trusting someone else to pick your stocks, you're in control. The potential upside is huge. Imagine getting in early on a company like Tata Motors back in 2019 and watching your Rs 10,000 turn into Rs 25,000 or even more by 2024. Yes, that's how much some stocks can grow if you make the right pick. But here's the reality check. Most people lose money in direct stock investments. Why? They lack the time, knowledge, or patience to research companies. It's not just about picking a stock and hoping it skyrockets. It's about understanding the company's fundamentals, market trends, and having a strategy. Without this, you're essentially gambling. Here's an insider stat you won't find on many YouTube channels. In India, 80% of retail investors in direct stocks underperform the market. Yes, 80%. So, the question is, are you prepared to beat the odds? By the way, if you're curious about how some of India's wealthiest individuals, like Mukesh Ambani, manage to build wealth while minimizing risk, check out my other video on the 5 financial secrets of Mukesh Ambani. It's packed with insights that might just change how you think about investing. But watch that after this one. Now, let's talk numbers. Over the past 5 years, the average large-cap mutual fund in India has given returns of around 12, 13 or 15% annually. Sounds solid, right? But some well-picked individual stocks like Reliance Industries or ICICI Bank have given a compound annual growth rate, CAGR, of 25-40%. That's double or triple what mutual funds offer. So, why don't we all just jump into direct stocks and start making those big returns? The answer, as always, is more complicated. Here's a scenario. During the COVID-19 crash of 2020, the Indian stock market plummeted by over 30%. Mutual fund investors saw their portfolios drop, but because of diversification, they didn't lose as much as individual stockholders who had concentrated positions in hard-hit sectors. Direct stock investors often see much higher volatility. So, can your portfolio survive these fluctuations, or should you rely on mutual funds for that cushion? What do you think is riskier, mutual funds or direct stock investing? Comment below with your thoughts. Here's something not many people talk about. While mutual funds are marketed as safer, there's a hidden cost involved: fees. Even if a mutual fund generates 15% returns annually, a high expense ratio could reduce your net return to 12%. And over 20 years, that difference adds up. Meanwhile, with direct stocks, you're only paying for trading fees. If you choose low cost brokerage platforms, your long term profits could be much higher. But again, it comes down to your ability to research and pick the right stocks. So, we come back to the big question: which is better, mutual funds or direct stock investment? The answer is it depends on you. If you're someone who wants convenience, professional management, and lower volatility, mutual funds could be your go to. But if you're willing to invest the time, research, and can stomach the volatility, direct stock investment can offer significantly higher returns. Ultimately, there's no one size fits all answer. The key is to align your investment strategy with your financial goals and risk tolerance. But here's the secret: many successful investors, including some of the wealthiest people in India, do both. They diversify into mutual funds for stability and invest directly in high growth stocks for that extra edge. And that's it for today. If you found value in this video, you'll love my video on Mukesh Ambani's financial secrets. Check it out on my channel.